Good morning and welcome to today's Five with Fitz. I'm, of course, Keith Fitz-Gerald. I understand that our new music is a hit. And then I understand some of you like the old music because you like the air guitar. But anyway, we're there. So thanks for watching as always. Earnings season is starting to quiet down, but there's still a lot of money on the move. Opportunity, of course, isn't far behind. That's the stuff you want to think about. I bring this up because people playing for pennies at moments in time usually lose out to those playing for dollars over time, right? There's an image in the written version of the Five with Fist. Take a look, burn it into your brain. Today's playbook, number one, Meta. El Zucco's moment of reckoning may finally be upon him. I say this because California's AG is co-leading the charge against Meta, and experts consider it a potentially much bigger, more serious case than the one Meta lost in New Mexico a few weeks back that's going to cost the company something like $1 billion in penalties. Anyway, I agree, and I've said that for a very long time based on my own experience with Meta's repeated refusal to take down criminals impersonating me, using my intellectual property, trademarks, copyright materials, etc. Now, interestingly, as I understand it, the case does not involve Section 230 of the Communications Decency Act, which Meta and other social media platforms have hidden behind for years. Now, this one focuses on a very narrow area of the law of Section 230 in general, alleging misrepresentations on safety related to app features and the failure to warn consumers of the dangers associated with using Meta, now youth especially. Now, Meta, of course, says that the limited claims are unsubstantiated and the financial demands, aka damages and penalties, are vastly disproportionate. Now, on this, we may agree or we may not. That's moot. What matters to me from an investing standpoint is that Meta could get positively shellacked in its stock carried out feet first. Why? Well, Meta needs every penny of whatever it generates, however it generates it, to pay for its AI ambitions. And anything that interferes with that potential could crater the stock if Wall Street agrees. Now, here's a trade idea. I believe that investors who have large positions may wish to do some prudent pruning under the circumstances. And those who want to speculate could potentially consider buying Leap's puts, a bet that the stock goes down. Now, volatility hasn't shifted yet to the downside as I record this, which means that those things, the long dated puts, are still comparatively inexpensive. Now, I'll have an idea or two in today's One Bar Ahead update, so do keep an eye on your email if you're a member of the OBA family. Keys investing tip: learning to trade around core positions is an essential skill, even if you have no trading aspirations whatsoever. And I say that because doing so will help you understand the psychology involved and assemble better, more consistent long-term profit potential by avoiding risks like this that can and do often surface out of left field. Number two, extended hours, not so fast. The CBOE had planned to launch extended hours options trading for mostly what they're calling the most liquid single stock names, including NVIDIA, Tesla, Micron, other mega cap heavyweights. Now, previously, this kind of extended trading was reserved for index products only, like the VIX, the SPX, that crowd. Anyway, and naturally, this is being billed as financial innovation. And based on what I'm seeing in social media, much of the investing public and trading public seems to have swallowed this line of thinking hook, line, and sinker. Now, drives me crazy. CBOE has plainly stated that more volatility means more revenue for them. So the exchange operators' incentives here aren't exactly neutral. In fact, they're decidedly one-sided, which is why you want to keep your eyes wide open, my friends. Pre-market options books are thin and spreads wide enough to drive a truck through, which is exactly the environment where inexperienced or uncapitalized retail traders and investors tend to get picked off by market makers and prop desks whose sole purpose in life is to maximize short-term profits no matter who they have to destroy and no matter whose money they take doing it. My POV: just once, I wish that regulators would clamp down on stuff like this rather than egg it on, for the simple reason that most investors are not even remotely prepared to deal with Wall Street sharks. And if the regulators are really there to protect the investing public, then dang it, they ought to be there in a situation like this. So a couple of things come to mind. First, the CBOE, I got to say it that way as opposed to CBO, but anyway, is deliberately concentrating on roughly 20 to 30 of the most liquid stocks, which means volatility on those stocks is likely to go up. And that in turn means new opportunity for anybody who concentrates on that group of stocks. It also means tremendous opportunity for concentrated specialized ETFs with options overlays on those particular stocks. Anyway, second, overall market volatility is likely to increase as well once trading begins in extended hours, because those same thin order books I just mentioned mean wider spreads, and wider spreads mean bigger swings on every headline that drops before the opening bell or after the closing bell. Think about it for a second. Earnings surprises, Fed speakers, overseas news breaking while New York sleeps. A single tweet from your your favorite rabble rouser. All of it's going to get priced into some of the most heavily traded options in the market, in the world, with far fewer players standing on the other side of the trade to absorb it. So a key investing tip: as scary as this sounds at first blush, it's important to remember that volatility equals opportunity. And that, my friends, means better lowball orders, better premiums if you're selling puts, and so on. Heck, it even means better opportunity for folks who are simply DCAing and VCAing into whatever stocks they want to buy. My point is, there's always a bright side, especially when it comes to your money. Number 3, time to Katie bar the door, or is the market's going to plow higher? Well, the VIX has dropped to its lowest reading of the year, 14.2, which means that traders are betting on 30 days of smooth sailing, if you believe the headlines. Well, I don't. And if you do, I have a bridge to sell you. August is typically a month of swoons, summer liquidity, algos overacting the headlines. So it's time to be on guard. Contrary to what many think, though, new highs and be on guard aren't a contradiction. In fact, they're the same trade. 8,000 plus on the S&P 500, a target I've put on deck, I think is still very doable this year, with one big caveat. It might actually be too low. Think about that. You see, 8,000 translates into earnings of around, 400, PE of 22. So if the PE finishes at 22 plus, which might be in the cards, we could see 8,300 to 8,400, which is going to catch a lot of people by surprise on the sidelines. So yeah, well, there could be a crash, or at least a late summer, early fall correction. Cruising higher is almost always far more profitable. Evercore ISI, by the way, just said it thinks 9,000 is possible. Now, I'm not sure I'll go that far, but I'll take it. And how about you? Anyway, key investing tip: be in to win, or you won't win. Number 4, Peter Thiel is buying into Vista Energy. Should you? Well, Peter Thiel is billionaire brilliant investor. He just closed a fresh stake in Vista Energy, the biggest independent shale player down in Argentina's Vaca Muerta. Now, that's nearly $76 million worth, making it the second biggest position in his whole book, right behind Amazon, if I have my facts straight. So naturally, the question on many retail investors' minds is, should I buy that too? Well, 2 things to think about before you do that, right? First, scads of investors think that they should buy just because insert your favorite known investor's name here did, but that's a very slippery slope. In fact, imitating a hedge fund billionaire can be very dangerous for your money. Thiel's buy works for his time horizon, his access to Milei's own government, his risk tolerance, and his ability to eat a loss and shrug, not yours. So think about yours. And second, you must ask yourself if there are better choices out there given your risk tolerance, your goals, and your objectives. Now, for me, the answer is yes, there are other choices. I prefer one that's more geographically diversified, has a lower long-term beta, lower break-evens, and so on, which means if I do my job right, I tend to get a smoother ride. The One Bar Head family, by the way, has this covered as well. And if you would like to know what they know about what I know, and boy, that's a mouthful. Anyway, you know where to find me, right here. So at number 5 today, I believe these 2 stocks have an exceptionally bright future. What are they? Well, I sat down with the fabulous Liz Clayman, who asked me back very kindly for a great conversation as we headed into Friday's close. She wanted my take on 2 stocks that, in my humble opinion, have an exceptionally bright future, starting again this week and continuing for the foreseeable future. In fact, I don't think investors who don't own them may be kidding themselves about being investors, right? Anyway, that's it for today. My tongue was tied. I've got redheaded lips. It was a long morning. Steady investors beat anxious investors, and the profits prove it. So on that note, you got this, I promise. Let's make it a great day. Start the week strong. I look forward to seeing you tomorrow. Cheers. Bye-bye.